on the phone. Is my phone up there? Oh, perfect. All right, like no hand. All right, I'll keep this quick, I promise. Thanks everybody for coming out tonight. Sean will keep this even quicker, I think. Basically, we're going to run through, the way that we view markets at All-Star Charts. So global macro, we're going to look at everything. We'll talk a little bit about the intermarket landscape, how we view things like the dollar and the bond market, and how all that plays into our analysis. Then I want to spend most of our time on U.S. equities, a little bit international, and we'll drill down and talk about really how we find the best opportunities in bull markets. A little bit about me. I started out as a fundamental person, just due to my background. That's kind of where I started. I was a CPA a long time ago. Lost enough money trying to be a value investor. Finally found technicals, and the rest is history. So I don't need to really spend much more time on that. This is our team. Love these guys. Luckiest man in the world. I work with some of the best people, smartest people in the industry. 5 CMTs, a lot of them are in this picture. 5 countries, provide analysis on markets all around the world, to people all around the world. Disappointingly enough, I'm not a CMT like Joseph. I'm still on level 3. Got busy a few years back, never got to it. But next time I come to Asia, I promise I'll be a CMT. There's got lazy. But really, there was some talk about fundamentals versus technicals. I think Nikki said it as well as anyone can. It's not that they're substitutes for one another, right? In my mind, they're truly complements, and you should be using both. And that's really how we approach things on the analyst team at All-Star Charts. Don't tell my boss. All right. So before we get into where we are today, I want to spend a little bit of time on how we got here, right? Because I've been getting yelled at since late last year now for buying stocks. It's a bear market, Steve. What are you doing? You're crazy. For 2.5 quarters now. So I want to go back to this time last year and kind of talk about the things that we were seeing and why we got aggressive when we did. This is a equal weight performance chart. We're looking at all of the equal weight sector ETFs here, and we're going back to June 16th. Does anyone know why I'm anchoring from June 16th, 2022? Come on. This is when the market bottomed. Joseph's shaking his head, he knows. The index is bottomed in October, but most stocks made their ultimate low for the cycle in the summer. We had a nice breadth divergence. We'll get to that in a little bit. So that's why we're choosing that as an anchor date. These are the sector spiders going back to October 13th. That's the date that the index is bottom, right? So regardless of how you cut it, everything's up. Everything is working. Some things more than others, like the NASDAQ, the growth stocks. So the NASDAQ 100 index is shown here, this spaghetti chart. Give you a headache if you look at it too hard, but what we're trying to show here is through the first 6 months of the year, it's the best start for the NASDAQ 100. Growth stocks are absolutely on fire. I'm going to rip through these really quick. If you have any questions, just stop me. I like to color format my tables for a reason, because you can really see here just kind of the transition as the bull market's getting older and older from mixed, a little bit of red, geared back some in May, all green on the screen by June. For the second quarter, everything was working except some defensive sectors down here, staples, utilities. Confident Energy will get it together soon. And these are the S&P 500 large cap sector spiders. Year-to-date tech is up 42%. Not too shabby. Another thing we look at when we look at these tables, just going back to this one real quick, is the risk on versus risk off groups, right? And when I look at this here, I see way up at the top, this is the year-to-date returns. I see the riskiest, most offensive stocks doing the best, and the most defensive stocks, utilities, staples, real estate, like I said, energy, Just leave that alone for now. They're kind of like Notre Dame, they do their own thing. It's the defensive sectors that haven't been participating as much. And that's okay. We'll talk about that in a little bit, why that is. This is all the mid-cap sectors. If you are reading too much news or watching too much TV these days, you might think that it's just large caps, it's just mega caps, it's just Facebook and Tesla and Apple leading the market. Well, when I look at the mid caps, I'm seeing a lot of green on my screen, particularly in the last month and the last quarter. The same is true for small caps. The S&P 600. So all of our small cap sector indexes, again, things are starting to get really good here in June. Small cap technology up 23%. Apple and Microsoft aren't in there. Size and style, really like our factor universe, right? So value, growth. Everybody's saying, hey, it's only growth stocks this year. See a lot of value on here, and it's all free, right? I also see small cap growth doing really well. I can get really obnoxious about this. We can go all day. Look at all the green here. Home builders, hardware, transportation, software, semiconductors, critically important pro-cyclical industry groups, some really offensive industry groups leading the charge. You look at the losers, regional banks, and we'll talk about that. They're kind of having their own problems this year. Q4 of last year is when the market bottomed, maybe the new bull began, right? How do you define when a new bull market begins, when an old bear market ends? We can argue about that all day. But this thing was kicked off by international equities, particularly developed markets over in Europe. So that's the MSCI EFA, it's developed markets, ex-North America. There's a lot of Japan in there, but it's really driven by developed Europe. They led in the last quarter of last year, they led in the first quarter of this year, and now we're kind of seeing the S&P 500 kind of take the reins and drive things, right? So we got the beginning of the bull kind of led off by international markets. Now we're getting this rotation to the US this year. The US is really showing some strong leadership the last 2 quarters. What this matrix is, sorry that it's so colorful, but it helps me kind of distinguish where things are as I look through it. It's a global macro table, and it's ranked. The best performers are on top by each quarter. So if you look, lately it's been commodities, gold, not working so much. Internationally, things are good as well. We have our international indexes, our global regions. Again, June, all green on the screen. Second quarter, everything but Asia is working. Same on a year-to-date basis. Can't see that, so I'm going to skip it. Okay. So everything's working. It's a bull market. How did we get here? How did we know it was beginning last year? This is October of last year. Probably right around, just after. So this is late October, just after that now notorious CPI print and a monster bullish engulfing candle. You can pull up the charts right now and see exactly what I'm talking about at the lows. Sentiment, measuring it here by the average bulls and the investors' intelligence and AAII surveys. Absolutely washed out. We haven't seen sentiment this low in decades. No bulls. Then when we look at the bears, more bears than COVID, you'd have to go back to the financial crisis for sentiment to be this washed out. So without even looking at a price chart, this time last year, me and the guys were sitting around thinking, we've got to be close, right? This is the kind of sentiment that, bear market lows are made out of. This is just the same chart zoomed in. Totally washed out sentiment readings. Everybody hated the market. FTX was blowing up. Everybody's losing money in crypto. Growth stocks are down, ARK funds 80%. Some quality stocks, Shopify, down 85% drawdowns. Markets really, really got hit in 2021, 2022. We'll run through this one quickly, but here we're looking at more than just the AAII and the II. We got the NAAIM in here, the volatility index, put call. So when we create like a composite of sentiment data, same thing, telling us time to look for a bear market low, right? Some sort of base, tradable low, some sort of reversal pattern shaping up. We also consider seasonality, when we think of what kind of environment we're in. So in October of last year, we were looking at this. This is just the average monthly performance going back about 70 years, all the data that we have. Typically, end of the year is a good period. January is usually pretty good too. So we knew that that was kind of at our backs. When we looked at the S&P 500 cycle composite, where we're looking at every year ending in 2, every midterm year, so that's what 2022 was, and every year between 1950 and 2021, shown in red here back in October, this was the composite. We're thinking, do we play catch up to the seasonal trends? Maybe. Price needs to confirm always, right? But still interesting. Always want to be aware of that environment, right? When we zoom out and look at the entire 4-year presidential cycle, well, shouldn't be that surprising that the midterm year was as weak as it was. Of those 4 years, it's usually the midterm year that's the weakest, right? You get usually some nice gains in the post-election year, a little bit of sideways in the midterm year, pre-election and the election year tend to be pretty well, pretty good. So we do all of these things, we're kind of coming together at the same time. Our list of, bullish environmental factors continue to grow. How about breadth? How about market internals? Same time, October of last year, we were completely washed out from a breadth perspective. So what we're showing here in the lower pane, this is the S&P 500 in the top pane. This is the percentage of S&P 500 components that are above their 200-day moving average. As you can see, marked in green, tends to be a pretty good indicator. When we fall below 15% and then reclaim that level, tends to coincide with some major market bottoms. Don't want you to look at this chart and think it's perfect and that that's all you need to look at to time the market in the future. This chart will be wrong one day and it won't work. But we'll be looking at 10, 15 other things and weighing them all. None of these indicators are perfect. That one's been pretty good though. So also in October, and this is that June 16th date right here, and this is exactly what I mean when I say the market of stocks bottomed in June of last year. This is a percentage of new 52-week lows. More stocks made their ultimate low for the cycle back in June. When the market made an incremental low in October, it was not getting confirmation beneath the surface, right? This is a bullish divergence. Fewer stocks were making new lows beneath the surface, despite the index doing just that. This is the bullish engulfing candle I'm talking about. That was a big day for the market. And like I said, we weren't just looking at this saying, wow, what a bullish candle. Let's get long. We saw that bullish candle and then thought about all the other things that I was just saying. And we have to monitor it. We have to monitor the progress, right? So there's the market of stocks bottoming back in June. There's that bullish divergence at the index lows in October. And then, just like we wanted to see, a base building process begins and fewer stocks making new lows. In bull markets, more stocks are making new highs than new lows. So we got to look at that too. We started to see internal strength, market breadth slowly expand, coming off those lows. This might have been the biggest one of them all. This was happening at the same time. Just a month before, not even a month before. This was late September, right here. When we had volatility just spike in both directions. This is the US dollar index. A couple weeks before the market bottom. Momentum hit its lowest reading since early 2021. We had this parabolic trend line in Dixie that broke as we had some sort of bullish continuation pattern printing. Bullish patterns fail all the time. That's what happened here. So this bull flag, bull pennant, short-term continuation pattern resolves lower, not higher. Momentum is spiking in both directions, which is turning point, inflection point kind of stuff. Momentum is hitting its lowest reading in over a year. We're thinking, wow, that dollar headwind might be dissipating. This was happening too. That's Muscle Man George Washington. And that Barron's cover came out right here at the peak. You tend to see that, right? These guys are all great writers. I read this stuff, I enjoy the articles, but by the time they get onto these trends, they're usually ending. I'm not just picking on them because of last year. We've seen it before. In fact, this was not an original thought from Barron's. We had Muscle Man George back in, gosh, I can't read that, but it was sometime in 2016. Pretty good, right? And again, just like the percentage of stocks below the 200 day, we're not looking at this and saying, oh, short the dollar, it's over. No, it's everything else we're seeing. And then something like this is just cherry on top. And it worked again. Why do we care so much about the dollar? Why am I talking about the dollar? We're trying to talk about stocks bottoming. Well, go back throughout history, and I can zoom out even further on this chart, show you all the same things. Dollar troughs, emerging markets peak. Emerging markets trough, dollar peaks. Dollar's working out a nice rounding bottom formation. Emerging markets are printing a big distribution pattern. Downtrend from emerging markets, uptrend for the dollar. Now we got a peak in the dollar and a bottom in emerging markets. Look at that correlation. Pretty good, right? When the dollar is weak or falling, stocks, not just emerging market stocks, but all stocks tend to be performing well. Anybody read John Murphy? It's not my thought. It says I'm stealing it from him. It's a lot better than I am. So it's not just about the dollar. We're also considering the bond market, right? Interest rates were rising, 21, 22. I think a lot of pressure, particularly on the longest duration assets, growth stocks, tech stocks. I talked about some of those drawdowns in tech stocks. Probably had a lot to do with rates rising at fastest pace in history. What are they doing now? The dollar's been coming off a little bit. I need to update this chart. We're making new lows below 100 now. We've got an oversold reading just last week. But rates have been going sideways. Right? They're not still going up. And frankly, I don't think we need lower rates. You kind of have to be careful what you wish for from an intermarket perspective. Rates started rolling over pretty hard right here. That could also not be a good thing, right? That could speak to some sort of impending recession, right? Fed's cutting aggressively. Sideways, just a little bit of, or a lot of nothing from the bond market, usually what we want, right? I don't want bond market volatility. I want rates kind of stuck in a range. I think that's what we're getting right now. Fast forward to today. This is the S&P 500 pre-election cycle now. This is the analog. This is where we are. It's been a good year, strong start. I think it's really interesting seeing this prolonged period, almost 2 quarters of sideways, right, in our seasonality chart here, because like I was talking about at the top of the deck, NASDAQ's having its best year, ever, start to the year ever. Everything's working, it's been tremendous performance off the lows from late last year. I think we could go sideways for a quarter or two, and that would be really constructive. I don't think that would be a bad thing at all. Maybe we get a little bit of sector rotation brewing beneath the surface. Industrial, small cap materials, some things start to work. Maybe tech and growth gives back a little bit. You get some sideways at the index level. I think that'd be really constructive. It's kind of where my head is at going forward. When we zoom out, S&P 500 cycle composite for 2023, same thing, right? Seasonality remains a tailwind, maybe a little bit of sideways, but then tailwind and ramp up into year end. What do you guys think about this? Just 7 stocks. 7 stocks are doing all this. Ray was right. It's not bad that top stock performers are strong. We were talking about basketball at lunch today. We're talking about Jokic and Nuggets, right? The best players are supposed to score most of the points. That's what you want, right? That's all that's going on here. The best players, Nvidia, Meta, Tesla, are scoring most of the points. With the largest weightings in the indexes. So if you're a passive investor and you're in the spiders or the Qs, that's exactly what you want. You want these guys to do the best. So they're kicking off a new bull market. Maybe it's something to do with AI. I think it probably is. But it doesn't really matter. These are like the most critically important stocks, the largest stocks in the world. It's not a bad thing that they're doing so well. So turn off the news if that's what they're telling you. This is the Magnificent 7 index. We've simply equal weighted those 7 stocks. Looks good, right? The bottom late last year and ripping ever since. Here's a look at breadth today. This is one of the most basic ways to just kind of analyze market internals. It's the S&P 500 cumulative advanced decline line. We're simply taking all the stocks that go up in a day and all the stocks that go down, netting that number and adding it. You almost always see it precede new highs at the index level, right? So that's where we are today. This chart would suggest that the S&P 500 too follows back and kind of takes out those highs from last year or early 22. Again, everything is working, not just 7 stocks. Another thing that we really kind of need to see to support the idea that a new bull market is underway is breadth thrust. And we're looking at that in a number or variety of different ways. I brought along this one because I think it's a little bit unique. Rather than look at the percentage of stocks making new highs, we're looking at the percentage of stocks getting overbought. We use the daily RSI 14 for that. So this is just showing you on any given day how many stocks hit overbought levels. Saw it, really spiked during COVID. That was red thrust. And that was around the same time we were getting thrust in the new high indicators. Now we have the highest reading since then. Another thing you want to see is exhaustion before the thrust. Percentage of stocks oversold, highest reading since the COVID lows. So we got the exhaustion, we got the breadth thrust. I could show you, we could do a whole presentation on just breadth thrusts. There are plenty of them, but it's just to make the point. Let's talk about current structure, these current price patterns that we're looking at every day. It's all about the basis. 2023 is all about basis, right? I mean, this is just classic reversal pattern. You have the downtrend. Downtrend on the left-hand side of the chart, a bunch of sideways. Nikki was talking about using mean reversion strategies in this kind of market, selling the highs, buying the lows. I'm not good at that. I'm not good at trading ranges. I'm good at trading trending markets. This range took way too long. This is one of the most prolonged bottoms I've seen in my career. But it was really, really textbook. What it really is accumulation, right? So what are some things we're looking for? The August highs, I think, are a great line in the sand for most indexes, most individual stocks. Even if you look beneath the surface, you're going to be talking about those August highs over and over and over again. In many cases, the year-to-date highs will line up with the August highs. It's not the case of the S&P, but it's some other indexes that we'll look at. So we can define our risk there, right? We're simply saying, okay, we're above the August highs. The path of least resistance is now higher. A new uptrend is underway. This is the equal weight NASDAQ. This is what I'm talking about. Year-to-date highs, August highs. That's the market telling me that level is very important. And then I'm thinking, ooh, why don't I define my risk there? So back above the August highs, the equal weight NASDAQ 100. Again, this is not the cap weighted NASDAQ 100, it's equal weight NASDAQ 100, which kind of speaks to the bullish breadth as well. 102.50 is that level. Now, the characteristics of the base breakouts that we're looking for, we did a little lunch and learn on this. I ranted about it for about 45 minutes. We're going to do it in 30 seconds here right now. I want to see the year-to-date highs and the August highs, right? It's this former resistance zone now being reclaimed, right? That's our line in the sand. I need a level that I can trade against if I'm getting long. I can't have some sort of messy chart. The more touches, the better for me. This is a good example of that. This is large cap communication services. Momentum needs to be in a bullish regime. What do I mean by that? On rallies, momentum is hitting overbought. On corrective phases, it's not hitting oversold. This is bull market momentum. This is what momentum looks like in a bull market right here. This is what it looks like in a bear market, right? On sell-offs, we get oversold. And on these little mean reversion bounces, we do not get overbought, right? So momentum is in a bullish regime. And then this. It's 200-day moving average. During trending markets, I don't even have it on my chart. I like to joke, if I don't know the direction of the 200-day moving average without looking at it, it's probably not something I want to buy. Probably a messy chart, right? I just be able to look at the chart most of the time in an uptrend and know that the 200-day moving average is pointing up. Because we had such a prolonged base building period, sideways period, I have the 200-day moving average on all my charts these days. All I'm looking at is for it to start curling higher, right? I want the 200-day to kind of flatten out below price and start curling higher. That is the case pretty much all of these charts I'm about to show you. Semiconductors. Above that line of sand with the August highs. 200-day moving average pointing higher, telling me that the absolute trend is up. Momentum is in the bullish regime. This is also, critically important pro-cyclical group. Semiconductors are the lifeblood of modern day economy. They're your new Dr. Copper, or your new, transportation index. That's really how we use them. Some call it modern Dow theory. Software. Again, seems to be at the forefront of a new bull market. It's so hard to bet against tech. It's the best stocks. It's been that way for multiple cycles now. Bullish momentum regime, 200-day moving average curling or flattening, curling higher. Back above those August highs. Path of least resistance higher. Let's just run through these now. Dow Jones Internet Fund, same thing. Some would call this an inverse head and shoulders. It's really just a nice base. It's rounding bottom. It's a reversal pattern. 200-day pointing up. Primary trend is now higher. Momentum is in a bullish regime. All of those charts I was just showing were growth and tech. What about the rest of the market? Industrials, another critically important sector. We've run the numbers. They have the strongest correlation to the broader market if you go all the way back, starting at the beginning of the S&P 500 in the 1950s. New all-time highs from equal weight industrials. Really good stuff for the broader market. It's also telling me, okay, this is a group that we want to look at for long opportunities. XLK is up 40–50% on a year-to-date basis. That's got to cool off and take a breather at some point. I want to know who's going to be next, right? What's going to catch that rotation? What will the good trades be in Q3 and Q4? I think industrials are that. And that's not to say sell your tech stocks, right? As the market or the rally broadens for the market, my portfolio broadens, buying more things, right? So I don't think you want to run and sell your tech stocks. Obviously, it depends on what your time frame is, but you want to start kind of moving into some other groups and other areas and asking yourself, who might the outperformers be over the short term, heading into the back half of the year. When I look at the indexes for industrials, I really like what I see. So new all-time highs at the large cap level, cap weighted, large cap equal weighted level, and small caps. I couldn't fit mid caps in here, but if I could, they would look exactly the same. They're all breaking out of these nice bases. If you zoom out, it's like primary uptrend, consolidation phase, and now breakout. Okay, if I'm going to throw money after industrials, I want to know that they're outperformers, right? So here's equal weight industrials relative to the equal weight S&P 500. Again, breaking out of this monster base, screaming higher, right? So the relative strength is really there for this group of stocks, and nobody's talking about it because everybody's so obsessed with tech. I like that too. Home builders. Let's talk about risk appetite quick. Like I said, semiconductors, definitely big from a risk appetite perspective. Those are the stocks that should be working in the bull market. Same with home builders, another pro-cyclical group there. These charts look the same. My favorite ratio, my favorite way to kind of analyze risk appetite is using the two consumer sectors. Right? We have discretionary, which is more offensive, risk on, growthier stuff. And then we have staples, which are really your safe haven stocks, quality, fortress balance sheet, they'll pay you a dividend. They outperform during bear markets. We're looking at XLY over XLP, so discretionary stocks over staple stocks. You could say offensive stocks over defensive stocks. That's why this chart in black, the line chart, the ratio chart, looks so similar to the index itself. During true bull markets, investors are moving out on that risk curve and trying to buy the riskiest stocks, right? They don't want the staples, they want the discretionary stocks. So seeing new 52-week highs in this ratio certainly supports a thesis of a new bull market being underway at the index level. We can also look at it this way. This is the broader market, the S&P 500 relative to consumer staples. So I put that defensive sector index in the denominator. So again, I'm kind of looking at offense versus defense. Nice base breakout. Looks a lot like the base breakouts we're seeing on absolute terms. So again, this is confirmation from risk appetite. Investors prefer riskier stocks. It's characteristic of bull market. I just thought this was a nice chart. Really hammering this point home. They don't want staples. They don't want the safe stuff, right? So this is staples relative to the S&P 500. Textbook distribution breaking lower from this, head and shoulders pattern, suggesting that risk appetite is alive and well. Same with high beta, low volatility. This is just another offense versus defense ratio. Investors kind of favor high beta stocks in bull markets as well. Nice breakout to new 52-week highs. And why are we talking so much about stocks? It's supposed to be like a global macro presentation, because that's where you want to be these days. Right? We always want to make sure, okay, if we're going to be in equities, they better be outperforming their alternatives. This is stocks versus bonds making new all-time highs. This is stocks versus commodities making new 52-week highs. Commodities were outperforming stocks for some time there. 2021, 2022, we were all commodity bulls. I think that continues, but that's not for today. I can't have an honest conversation about risk appetite without showing this chart of Bitcoin. It's a couple weeks stale now, but we're still battling at this 30,000 level. We had a little bit of a false start a few days ago. I got excited. Former support turning into resistance. You got a nice little base pattern here. You could say it broke out at 25. I kind of want to see 30 for confirmation. It's not black and white, right? You can kind of pick your line in the sand and say, okay, that's where I get the base breakout. I think 30 is really the big level here. If we anchor a VWAP from the highs for 2021, it's kind of reinforcing the fact that this 30,000 level is very important. I think if Bitcoin goes, it's really go time. We go back to those old highs and probably a lot more, right? And if that's happening, I'm asking myself, what are stocks doing? Will be the first time that Bitcoin was ripping and stocks weren't. That is going to be the case. So it's not the bet I want to make. Okay, so Bitcoin breaking out here would be a major positive for risk assets, particularly equities. Just wanted to show this since we're doing a presentation on technical analysis. It's no coincidence that Bitcoin and Ethereum are basing and building out these, beautiful reversal patterns right at the prior cycle highs. This principle of polarity happens to work really well with cryptocurrencies, not just stocks and other assets. Tech and Bitcoin. The way we think about Bitcoin and really all cryptocurrencies is just as another subgroup of technology. Right? We got semiconductors, we got internet, we got software, computer hardware, and we got crypto. It's just an industry group of tech in my mind. Probably the longest duration one of them all. Nice base, just like we're seeing from tech and tech subsectors. We think this base, just like all the other bases we're seeing in tech, will also resolve higher. So there's a correlation in the lower vein. Why am I looking at technology in France in the same chart? Anybody know what these two have to do with each other?
Semiconductor.
No,
I'm not sure. Sorry.
no, it's a trick question. Really nothing. There's like 5% tech stocks in the CAC board, right? So what I'm trying to illustrate here is that it's not just tech, it's not just large cap tech, it's the best stocks, right? The best stocks, the best indexes from all around the world, they look like this. They're back at those former highs, and in many cases, even reclaiming them and taking them out. Let's run through some global indexes real quick, just to hammer this point home, that it's not just a US thing. Things look really good all around the world. This is the German DAX making new all-time highs. This is the FTSE MIB, this is Italy, making new multi-year highs, beautiful base. Do 33-year highs for Japan, this is the Nikkei, probably the biggest base of them all. Vietnam, the largest frontier market, just like we were talking about high beta or discretionary stocks as your offense, as your risk on. Vietnam is risk on, around the world, right? Investors are favoring some of the riskiest stocks. This beautiful reversal pattern. I think the path of least resistance is higher as long as we're above those pivot highs. Emerging markets ex-China, nice base, really clean. You can find your risk right there. Momentum's in a bullish regime. Emerging markets small caps. Got a base breakout, not as clean. Momentum looks good. You got 200-day pointing higher. It's all charts I would buy. Large cap tech. Look at where we went. What do we do now? Do we buy tech and growth and these indexes or stocks that are back at their all-time highs, bet on continued outperformance? It's another one. SMH. Do we bet on a breakout here and continued outperformance? Here's software and services, XSW, this equal weight software, failing at that, clean resistance stuff. I think it might have reclaimed it by now. But my point is, there's some really logical levels of overhead supply in some of the strongest groups. Apple and Microsoft, two biggest stocks in the world. Technology versus the Russell 3000. When we look at tech on a relative basis, I can make an argument that it would make sense for them to kind of cool off in terms of outperformance right now. Right, running into the dot-com bubble highs against the broader market. IWB is the Russell 3000, one of the best representations we have of the overall equity market. Now let's talk about some of the weakest indexes and groups. Small caps have been weak, right? But even throughout all that weakness, they're holding on to some key levels. It almost looks like Bitcoin, right? Holding on to those prior cycle highs and letting the base building process play out right there. If charts like the Russell or financials were breaking those prior cycle highs, right? And the laggards were leading to the downside. I'd say, oh, okay, maybe we should probably heads up. Maybe we're entering some sort of corrective phase. But even the worst indexes and the worst stocks, let me remind you, back in March, we lost some of the biggest banks in the United States. They blew up, went to zero more or less, right? Financials held this level. Same microcaps, key level, holding those pivot lows. When you zoom all the way out on financials, you see this polarity, principle of polarity playing out here. The pre-great financial crisis highs, way back in 2007, happen to coincide with the 2018 highs, the early 2020 highs, and the pivot lows. Market has memory. When we equal weight financial sector, at what looks to be a pretty ugly top, now some sort of bearish continuation pattern, right at this key level, the prior cycle highs, but it's not resolving lower. In fact, a lot of regional banks and smaller cap financials are resolving higher from these little continuation patterns right now. This is one I would stay away from. There's no reason for us to go out and buy the banks right now, especially the regional banks. If you want to take a shot at JP Morgan or some of the large money center banks, fine. But I think the way that bank stocks trade and the way that we think about banks in the United States is changing, right? These companies are being socialized in a way, right? So if their downside is being capped, you better believe their upside is going to be capped. They're going to be the ones paying for this. Value line geometric index, 1998, pre-great financial crisis, 2014. We've seen this level so many times, not breaking, right? So the downtrend in 2022, look at where it stopped. Energy is now one of the weakest groups. They were the strongest group 2021, 2022, 2020. Now they're one of the weakest groups. But look where they're holding. It's prior cycle highs, 2018 highs. This is large cap energy, this is energy stocks in the USA, this is crude oil futures. These charts are going to resolve in the same direction. For now, they're both holding and rebounding off this critical support level once again. I think there are some real opportunities, like counter trend opportunities from a relative strength perspective in some of these weaker groups, because during bull markets, and to me it's overwhelmingly clear that it's a bull market right now, during bull markets, the weakest stocks catch up to the strongest ones. So we're looking in these groups as well. And again, we're not ignoring tech stocks. We're still looking at opportunities in technology. We're just kind of broadening our scope. This is coal. This is coal, similar to energy, kind of holding those prior cycle highs. Looks like a top, but what if it's not a top? Tops fail all the time. This doesn't have to resolve lower. Online retail, let's just look at some niche industry group ETFs right now. It's online retail, kind of holding the lows. Chinese internet, these have been some of the weakest stocks, holding the lows. When we look at small caps on a relative basis, logical level to assert some leadership, even if only over the short term. Nice bullish momentum divergence. These ratios are all saying the same thing. This is small caps relative to mega caps, small caps relative to tech. Basically, I'm putting the strongest indexes in the denominator. Because if I'm going to buy something or even look into buying something, I want to know that it's stronger than the strongest groups. They're stronger than the strongest stocks. So that's why I'm using mega caps and tech as the denominator. Relative rotation graph. So S&P 500 is our benchmark. We're looking at our universe of sector spiders here. You see tech in the top right, leading quadrant, tech, communications, NASDAQ 100. Like I said, discretionary is pretty growthy, so that's up there too. And then there's things like financials, real estate, utilities, staples, anything that's moving down and to the left, I'm really not interested in. Industrials, trying to tick higher into leading and hopefully eventually, improving and then leading, right? You kind of want to see this kind of emotion and then get into it like over here or popping into these grouping quadrants looking at the leading. We're not looking at these too much internally. The way we would be doing this analysis would be looking at 20, 30, maybe 40 different charts, the ratios themselves of these sectors, right? I didn't want to bring an extra 40 charts. I could kind of show this or illustrate this pretty easily in just one slide. So again, kind of interested in industrials. This is now the same RRG analysis, but using equal weight ETFs and benchmarks against the equal weight S&P 500. Here's industrials up and to the right. Okay, how are industrials doing versus the best stocks? Like I said, if I'm going to put my money there, I want to know that they're outperforming or can outperform the leaders. Technology is the leaders, coming off of these lows from 2021, very logical level for this underperformance, this industrials relative to tech. Logical level for that underperformance to end. Maybe see some mean reversions in the relative strength line here. Remember this one? On an absolute basis, these things are all working fresh breakouts. Relative to the equal weight S&P 500. Screaming higher, really showing off the outperformance. Okay, so then what do? Once we make the determination that we want to be in industrials, I want to look at the whole list of industrial subgroups or industry groups. And I want to start charting all of them relative to industrials or even relative to tech or the broader market, like the S&P 500. So that's what this is down here. This is Dow Jones Building Materials Index relative to the S&P 500. Monster-based breakout. This is now telling you that the relative trend, that for the relative trend, the path of least resistance is higher. This is one of those bases that we're talking about. On an absolute basis, path of least resistance is also higher. Then what do? Okay, we want to be in building materials. Now show me all the building material stocks, right? All the components of the building materials index. And I want to see a breakout in absolute terms, especially somewhere I can define my risk. I've got some old highs there, nice little polarity zone to 85, and new highs relative to the broader market. This is Boise Cascade Metals. They do things with wood and lumber. Maybe goes into the whole home builders bull market thing. Getting a breakout in absolute terms and a breakout in relative terms. This is one that we'd be looking at, putting a trade on. S&P 500 electrical components. Like I said, we're not looking at tech anymore. Maybe we're just looking for some rotation beneath the surface within tech. Maybe software, semiconductors are a little, overheated right now. Okay, how about electrical components? On a relative basis, electrical components are working on, massive base, almost a decade-long base that we're about to break out of. Right, so let's look there. Got a nice breakout in the absolute trend too. Belden, BDC, new highs relative to the broader market, new highs on an absolute basis. We would be looking for levels to define our risk and enter on the long side. We'll send you the slides, don't worry. All right, this is Marathon Digital Holdings. Sean and I have been having a great time with these Bitcoin miners since we got here. The market's been good to us. It usually goes down when we're traveling. This time it's ripping, so that's nice. If anything, we're staying up very late trying to manage our risk, take trades off. But Marathon's been a big one for us. Sean will talk more about it, I think. Marathon on a relative basis, this chart looks even better now. It's about a week old. We're getting some sort of a breakout relative to the broader market and a really nice base on absolute terms too. These crypto miners they're not crypto miners, they're Bitcoin miners, and that's why they look the way that they do, because they're highly levered to the price of Bitcoin, right? They look so good right now. We've been buying a lot of them. Right, is another one that we like. DraftKings might not be the most actionable right now. You might be able to catch it still coming out of the short-term coil, but it's just a great example of kind of what we're looking for in this market, right? Just like we talked about, all the characteristics of this base breakout or this textbook reversal pattern that we want. 200-day moving average is now sloping higher, telling me that the primary trend is up. We have a really clear resistance level here that we took out, right? At the August highs. That's our line in the sand, 2150. Now we have this tight coil, this bull pennant that recently resolved higher just last week. Sometimes, if you don't get the reversal pattern breakout, so if you can't get in at 2150, this is your best shot to get into these stocks. You want to look for some sort of high and tight coil or short-term continuation pattern, and you can buy the pattern breakout from there. So we put this trade on at 2150, and we liked it so much, we wrote about it again when it was coiling, said you could break it right, or you can buy it on the breakout right above these pivot highs on the upside resolution of that bullish pennant. The other thing that obviously needs to be in place, we're going to be expressing a bullish thesis via DraftKings, is I want to see the relative trend also breaking out of the base, right? Nice reversal pattern relative to the broader market, telling us that we can expect more outperformance from DraftKings in the future. Right, so we always want to be in the leaders. Airbnb, this one recently broke out also. 130 is our level. Again, you see the 200-day trailing up. Pretty clean level. We did get a little bit of false start there, but 130 is a good place. I think this relative trend has since broken out. We've kind of been jumping these reversal patterns a little bit because we're looking at so many charts these days and we're seeing the same pattern over and over and over and over again, and they keep resolving higher. So I think we kind of bent the rules a little bit on this one. We got into it before we even got the upside resolution. It's worked out so far. Let's talk about international stocks really quick, and then I promise I'll shut up and let Sean come up here. This is a RRG, but instead of using the US sector ETFs or sector indexes, we have a nice little universe of international indexes. So we've got the BRICS, we got Asia ex Japan, frontier markets, emerging markets, the EFA index, we got Europe down here in blue. This is a diversified global index, the S&P 100. Latin America really stands out. it's really important to know what your benchmark is. This is this universe benchmarked against the S&P 500, which is red hot right now. This is the same universe, but benchmarked against the all-country world index ex-US. I've removed the United States from the equation. Doesn't look like many good options when we include the US. When we take the US out, okay, it's a couple things. EMXC, that's emerging markets ex-China. EEM, frontier markets looking higher, right? Things start to look pretty interesting. So let's focus on those diversified indexes. Here's EPA that we talked about at the top of the presentation. It kind of kicked off this new bull market late last year, really the last 2 quarters of last year. But then it printed a distribution pattern. This is EPA relative to the S&P 500, and it's resolved lower. And now it's resolving lower from these little bearish continuation patterns, showing me zero evidence that that underperformance is going to end anytime soon. So we're not looking for long opportunities in EPA right now. It's not a leader. India looks good. Japan is interesting here. Right? Europe, really not interested in. Again, they kind of started the bull market. They've given some back from a rotational standpoint. I'm sure they'll get hot again, you know, in the later innings of the current cycle. But right now, Italy, Germany, France, UK, not interested. These are all the countries that we are stopping at during our Asia Roadshow. Taiwan looks good. Vietnam looks particularly good. I wish I had better news for you guys, but the Philippines does not look so great. 10-year yield in the Philippines. I don't really have anything to say about that one. But you should probably pay attention to it if you're investing locally. SEI looks kind of messy. You guys could probably do better technical analysis on this than me. Just want to include it. There it is in US dollars. Coming off those lows, right? That's interesting. In bull markets, this is not uncommon at all, right? As technicians, we would look at this pattern and say, oh, wow, distribution, it keeps testing. The tests are getting more and more frequent. The textbook tells you this breaks down, doesn't it? Yeah. Like, pretty good. Look at these tests getting more and more frequent. But I was talking to somebody, I think just in Thailand, and he was saying, gosh, Thailand, this top looks so ugly right now. I said, it's probably going to fail. Be careful. Don't get too aggressively short. Everything else all around the world is working. Do you really want to make the bet that this one country is going to break down, start making new lows and break down from this massive distribution pattern? No, distribution patterns fail all the time. This is a top, and it looks like it's failing right here. You can draw a trend line, you can do all sorts of things. I'll be completely honest, it's the first time I've looked at this chart. This is EPHE. This is how we would have to express a bullish thesis on the Philippines for the most part, until I open a brokerage account with Nikki. But really, this is what we have as an option for the Philippines. I think it's the MSCI index. No, iShares. Yeah, iShares MSCI. Again, coming off some pivot lows here. I don't know why we have this rectangle drawn where we do. I'll have to check on that. That should probably be a little bit lower, but we're holding the pivot lows again, really rebounding nicely. Okay, we do this every week. We're looking at all of the largest stocks, foreign stocks that are listed in the US. We call them ADRs. Right, so this is our ADR list. We call them International Hall of Famers. They're just the largest by market cap. And then we filter by relative strength and allow the strongest names to kind of rise to the top. And then we look at all the patterns. We buy the most bullish chart patterns where we can clearly define our risk. Some things that are standing out last few weeks, Taiwan Semi. I mean, this is really, you know, the big behemoth, tech behemoth here in Southeast Asia. Taiwan Semi, 99 is a key level. Year-to-date highs, really clean chart, 200-day moving average, curling higher. I want to see that breakout in the relative trend line. Really want to see that breakout to make me feel good or suggest that I'm going to be in a leader if I buy this stock. Sean and I bought this one the other day. I think I bought it last week. We just wrote about it, yesterday? So this is VIP Shop Holdings. It's an online retailer in China. Chinese stocks do not look very good right now. Most of them look pretty bad. This one looks great. Broke out of its base long before most things did. So it's either early this year or late last year. So we got a nice base breakout. I've color coded the 200-day to make my job easier. So I don't have to say, is that sloping higher or not? It'll just turn green when it's sloping higher. That's all I need to see. That checks the box. Bullish momentum regime, done the same thing with the RSI 14 indicator. We got the base breakout. So this is telling us, okay, primary trend is now higher. And then a long consolidation. I really like this long consolidation. It's things are coiling tight here. We kind of broke out of the range, then checked back. This is where we got in, playing it against the 1625 level, and then look at the relative trend. You have a nice little base and then a lot of sideways. The long-term moving average in relative terms, sloping higher. I think it's only a matter of time until this chart starts moving up into the right. So that's it. That's all I got. If you do want the slides, just email info@allstarcharts.com. Tell them what slides you want, and we'll get them to you. I'm gonna let Sean come on.
Get them. Is this on? Yes. The last time I was handed a mic, I was in a karaoke bar in Midtown Manhattan about to sing Dancing Queen. So I promise I won't do that unless you really want me to. I'll take requests later. All right, good news, guys. We're getting kicked out of here in like 10 minutes. And Nikki and my bro Joseph over here and Straza just crushed you guys with charts. I got even better news for you. I got no charts for you. You know why I have no charts for you? Sorry, Joel. Charts are bullshit. After you put the trade on, if you've done all that analysis, once you put the trade on, charts are overrated. Charts are bullshit. Yeah, that's right. I said that at a CMT event. How many of you have put on a trade and lost 1% in like a day or two or a week? Anyone? Right. We all have, right? How many of you have put on a trade and made 10% in a month? You guys done that? Which trade's more damaging to your portfolio? Trick question. The time you lost 1%, you lost money, but you know, that was part of your plan, right? You risked that amount of money and that was your plan. You were out. The trade where you made 10%, stock went your way. You took your 10%, you were pounding your chest, you were super excited that you made some money, you had a made your month. But then that stock goes on and triples after that. How you feeling when that happens? I bet you're feeling a lot worse than after you took that loss where you lost 1%, right? Even though you made money, I bet you're feeling terrible about that trade. I am. I've been trading for 25 years and I'll tell you that the worst trades, the worst times, the times I've been so upset at myself are the times, not when I've lost, but when I've left money on the table. Because when you leave money on the table, that messes up your mindset. And the mindset is the most important thing for a trader. Not charts, not all the fancy analysis you did, not your inside information, not your uncle's tip. None of that shit matters. If your mindset's screwed up, you got nothing. You can't trade. You're going to be trading impulsively. You're going to be making mistakes. You're going to be trading too big. You're just going to be doing everything wrong. So how do we keep ourselves in the game? How do we prevent that from happening? It all starts up front. After you've done all of this analysis, Nikki, great stuff. Joseph, that process that he goes through to find ideas is amazing. Straza, he's a wizard in what he does, right? But once you've got that trade, once you've got that idea for a trade, what are you doing? You're not just pounding keys and buying as much stock as you can buy, right? And getting in. No, well, you can. Some people do that. There's a lot of new crypto traders who've been doing that lately. They're having a wild ride. Mostly into the gutter. To keep yourselves in the game, to keep yourselves with your most valuable asset intact, your mind, it starts at the top, position sizing. You have to give a lot of attention to your position sizing. Now, everyone has different risk tolerances, right? Some of you might like to risk 5% of your portfolio on any one trade, maybe 10%, depending on your time frame. If that's you, do you, okay? That's great. Just be consistent. I don't recommend risking it that much in any one trade. You may have a different time frame than me, and that's okay. We all do things differently. I personally, I rarely will risk more than 2% of my capital in any one trade. Usually much less, maybe 1%. One of the best traders I personally know is named Peter Brandt. He's a He was featured in the most recent Market Wizards book. I think we mentioned Market Wizards book earlier today. He's a personal friend of mine. Used to live near me. I live in Colorado in the United States. And when I first met him, he told me, he said, Sean, losing trades are easy. I can handle those. I have a plan. I know where my stop loss is. I've risked X amount of my capital. By the way, he only risks 50 basis points of his capital in a trade. This guy's made millions over a 50-year career. One of the most wealthy traders I personally know. He's made all his money from trading. He only risks 0.5%, maybe even less on any one trade. He said to me, he said, Sean, the losing trades are the easiest trades. I'm out. Don't even think about it. I got my stop loss in, I'm out, done. The hardest trades for me are the trades that I get into and they start ripping right away. Right away. You would think you'd be ecstatic, right? You got a trade, it's going your way, you're making a lot of money, everything's exciting. Your wife is prettier, your kids are happier, everything's great. But he said, no. Those trades are ripping. Every bone in my body wants to take that profit. I just made 10% in a week on my trade. I want to get out. I want to book that profit. But he said, I've learned the hard way, Sean. Every time I've had a big winner, they always started out as a big winner fast. Those have always been my best trades, but they're the hardest ones to hold because those are going to be the wild ride. You're going to have some volatility. You're going to have some big ups, some big downs. But as long as your stop loss levels, you technical analysts know this. You know how to watch charts and know where the key levels are. As long as the stock stays, or the commodity, or the currency, or the Bitcoin, whatever you're trading, as long as it stays above those levels, you got to keep your head in check. You got to stick to the plan. Because if you don't have your head in the game, you're going to screw yourself. You're going to lose money. You're going to make mistakes. And in this business, I've been trading for 25 years. I can tell you, in this business, you only have to be wrong once, and you're done. You're out of the game. It only takes once. One bad trade, one bad run, one bad oversizing in a trade, one bad tip from your uncle. That's all it takes. The only way you avoid those disasters, position sizing, honoring your stop losses, sticking to the plan. Now, I'm an options trader. I don't think there's too many options traders in this room. I've had a chance to talk to some of you today. That's been kind of the theme as we've gone around Asia the last 12 days. So I didn't come prepared to give you guys a whole tutorial on options trading, but I will say that one of the reasons why I love options trading is because of what we're talking about here, this mindset, this being able to define our risks and keep ourselves in the game. With options, I can very clearly define my risk. Whereas a stock trader or a futures trader or a currency trader, if you have a position on, you want to manage your risk, you're putting a stop loss order in, right? I hope you're all nodding your heads. You're all putting in stop loss orders, right? Okay. That's great, and you should do that. However, every once in a while, especially if you're a stock trader, you might have a position on. I always like to talk about biotechs if they're an easy one to pick on, but if you have a biotech stock on, you're long, and let's say it closed today at $100 a share, and then overnight it comes out with a news item about some failed drug test. They have a drug in the pipeline and it failed the test, and the regulators are not going to approve the drug. Well, you might have a stop loss on that $100 stock to get out at $95. But if the stock opens tomorrow at $45, what happens? You can't manage that risk. You're out. You're going to hit the bid at $45 and you're out. Monster loss, right? It doesn't happen very often, thankfully. But it has happened, and it does happen, and it will happen again. So you have to be careful. And the only thing that keeps you out of trouble in that case, position sizing, not having too big of a trade. Now, I'm an options trader, so what I like about options trading, like I was about to say, is that I can more clearly define my risks. If you buy a call option, the most you can lose is the premium you pay. The stock could go to zero. I'm only going to lose whatever I pay for that option. And as long as I risked, let's say I'm comfortable with my portfolio, I'm comfortable losing 1,000 Philippine pesos. Is that a suitable amount of risk? I don't know, 20,000 Philippine pesos. If that's all I want to risk, I could buy that call for that price and stock could go to zero, and that's all I lose. I could do complicated option spreads, but all in a way to achieve the same thing. I can define my risk. That's how I sleep at night. Our boss, JC Peretz, it also charts like the T speeds. I talk about wanting to sleep at night all the time. I'm the oldest member of the team, so I'm the old guy. And he likes to make fun of me because I like to sleep. Sorry, I have a kid, it happens. Look, guys, I'm gonna leave you with this thought, and this is it. Do what you can to keep yourself in the game. I've been trading for 25 years, and the only way to be successful, the true secret to success in trading is not a whiz-bang indicator. It's not managing a hedge fund. It's not getting a job working for George Soros. It's not, there's no secret like that. The only real secret is you have to get from point A to point B. Point A being the day you first start trading or first become a CMT, right? And point B being success. The only way you get from here to there is time. You have to put time in. You got to have your ass in the seat, stare at charts, experiencing the market, ups and downs. And the only way you experience time is by not losing your capital. All right, guys? You've heard this all before, I'm sure, but maybe you didn't hear it in this way. All right, we are almost out of time here, but we'll leave it open for a couple minutes for questions. If anyone has questions, and for me, for Straza, for Nikki, for Broseph, Joseph, even you. What do you got?
Put my hand up and take questions.
Oh. Joel, I'm sorry what I said. Sorry.
But you're right. In fact, what charts tools provide you a system to execute your trade. But as Sean mentioned, none of it matters if your mind is not there. It's a mindset. So yeah.